Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner Hari.
Hello.
Today, in this episode, we will talk about Five Below, a company that was suggested to us by one of our dear listeners and an active member of the Slack community. So we'll talk about this. We'll talk about this company in this episode. Before we do that, Hari, give us a disclaimer.
Yeah, this is the Value Investor TV podcast. We're a podcast that helps you understand the concepts behind value investing. And we are not financial advisors, nor are we tax advisors. So if you're making any financial decisions, please consult with the appropriate advisor before doing so.
Great. Before we start the discussion about Five Below, maybe we should highlight a few things about our Slack community, the checklist, and things like that. So I'll just go over that really quickly, Hari. So as you guys probably know at this point, every time we value a company, we go through a checklist. And the checklist is available for you guys also. As you guys follow along to our podcast, you can also go through the checklist yourself. That way you can compare notes with your notes and our notes. So checklist is available. Just email us at info@valueinvestor.org, info@valueinvestor.org. And if you would like to be part of the Slack community I mentioned earlier, Slack community is where you can come online and you can chat with us directly and also engage with the rest of the community. So if you'd like to do that, also email us at info@valueinvestor.org. All right, Hari, let's get started with our checklist items. And as I mentioned earlier, this is a company that was suggested to us. So if you guys have companies that you guys have in mind, definitely send those our way. So we will put them in our backlog and go through them. So let's just get started here. So the first question off the bat, what does the company do? And you gave me a hard time for this. You should be able to explain this, answer this question in less than 2 sentences. So, Hari, let's see how you do with this one.
Okay. They sell stuff. Next question.
Sell stuff. Next question.
Yeah, so Five Below is a retailer that targets the demographic of age 5 to 19 and beyond, as they say, with items that are priced originally at $5 and below and now $10 and below. With a high turnover rate of their items, along with a high seasonality of the items that they sell. So the idea behind this store is kind of, as they put it, allow customers to let go and have fun. And their pricing is such that their target demographic, who they say has a lot of disposable income because most of their needs are already met by their parents or, by their parents. All of their cash is spending money, quote unquote. So they're coming in to buy items that are, at affordable prices, and, frequently visit the store.
So personally, I lived in Midwest and then Texas, now in California. I haven't personally seen them. Are they geographically, are they kind of isolated to a particular segment of the U.S.?
Yeah, so they have stores in California, but most of their stores are Midwest, Southeast, and Northeast. So they haven't really penetrated the Northwest market yet, and the only real stores are in California. So everything else, there's kind of a big gap as you go west of Texas. I personally have shopped there several times, taken my kids there, and there's lots of, they have a wide assortment of things, toys, candy, tech stuff, drawing crayons, things for arts and crafts. So, it kind of, it's a wide variety of things that they cover, and they put them in these categories: style, room, sports, tech, create, party, candy, and now are the 8 categories that they have. So it's it's a broad arrangement of stuff, and most of their stuff it's because it's $5 and below. It's there's seems to be like a you can go in and easily kind of load up on things. So you're not you have this discount mentality, and in the midst of recession or pandemic like this, like we're in right now, they seemingly have a it's not a big burden to shop there, so it's not a luxury kind of item. And they do have an e-commerce presence, but most of it is physical. So
I see. We'll get to this kind of more in detail about the competitive advantage and how they compare to kind of different. When I heard about this company first, I thought about Dollar Tree, Dollar General, that kind of store. But we'll get to that in a minute as we talk about competitive advantage. So the second question on the checklist is, does the company have a competitive advantage? Describe them in the categories below. So we'll go through these one by one and get your opinion on that. So first is brand. Do they have a competitive advantage from the perspective of brand?
So I think so. The thing that makes them kind of competitive, I would say, is that they claim that their demographic is a plus, and I didn't really think about it this way, but the teen and tween market, all of their needs are basically met, food and all that stuff. So everything that they have is basically disposable income, right? For the vast majority of that. And there's 62 million people that fit that demographic. And so, kids will be able to take their spending money and go there and buy, things. And, there's a wide variety and assortment of things. And, we're coming up on the Easter holiday right now, and if they were open, I would imagine they have a lot of Easter candy, Easter elements. So I think there's two things that make that brand kind of competitive, right? Is there's always a new assortment of items in the store, and all of the items that are in the store are they kind of put a kind of a hip vibe in the store. They play music, and they have items that are kind of seasonal and stuff up front, so that they, when you walk into the store, you're hit with, most of the time I've walked into the store, it's been, they have sports balls and things like that, so that you're kind of have this immediacy of, oh, that'll be fun to play with, or that'll be cool to look at, kind of thing. So the store is pretty well, and they claim that their competitive advantage is that their executive team is very, very well versed in the retail space, that they know a lot about retail and how to attract people and build a brand. So, and they say that leads to a high loyalty amongst their customers. And I've shopped there multiple times, and I would say many times when I do go to look for certain items, for my kids or something like that, that's kind of where I go. So there's nothing there that you couldn't buy on, say, Amazon or some other place, but there's a lot of kind of discovery when you walk into the store that you're like, oh, that's an interesting thing I wouldn't, have sought out. And then you kind of make a lot of impulse purchases when you walk in. So maybe you go there to buy, Easter candy, and then you walk out with a t-shirt and a cell phone case and something else. So not unlike the Target kind of model, right? I went to Target to buy laundry detergent, and I walked out with $300 worth of crap, right? It's not all that different from that. So
yeah.
And I think I would lump all of that into brand, but I wouldn't say that it's necessarily the strongest, moat, right? So I think that's one thing, that they have in their favor is brand.
Yeah, it is interesting, especially when you talk about that demographic in particular, who might be more sensitive to brand equity of a company than other demographic, for example, right?
Yeah.
So it certainly does play a role here. It sounds like brand does. So let's move on to the next category, which is network effects. Any network effects here?
Not that I can think of. I mean, I don't see anything here that other kids would kind of take, go there because their friends are going there. I don't see that. They're not really selling anything that's kind of unique to them that makes you want to shop there because other people are shopping there. So I don't see that.
Okay. And then the third is switching cost. Any switching cost from going to Five Below versus going to Dollar Tree or Dollar General or Target?
Well, I do think that they have different demographics. And, they're in their mind, they compete with mall-based, stores. They compete with discount retailers. They compete with sporting goods places. If I were to say Five Below almost reminds me of a little bit of Tractor Supply, in that you can go to Tractor Supply and get everything that you need in one place. And if you were to go looking for stuff elsewhere, you would have to go to 3 or 4 different stores, right? And so Five Below is kind of like that, but it's mostly things that you don't actually need. It's just kind of fun stuff, right? So, but there's hardly any stores that are selling candy, tech stuff, cell phone chargers and t-shirts in the same place, right? That's not a huge giant store like Target or Walmart. So and they also focus on a lower price point, so it helps mentally. People are going to say, well, I'm never spending more than $5 when I go there, even though I'm buying 5 or 6 items that are $5 each, right?
So maybe just to recap that, so it sounds like the assortment of products they offer in one-stop shop, but assortment of products is unique products, but offering in the same store, and also the price point sounds like a pretty interesting value proposition for a customer.
Yeah, and I would say that they're when you look at Dollar General, one of their biggest advantages is that people they position themselves such that if you were trying to go to the grocery store or going to Walmart to pick up your stuff, you could stop in Dollar General and avoid a long trip, long car ride to Walmart, right? I don't necessarily get that sense with Five Below. If I didn't go to Five Below for 2 months, I'd be fine, right? It's not it doesn't end my, it isn't the destination in and of itself, right? I may end up still needing to go to Target, even if I go to Five Below, or I still may need to go to other places, right? And I'm not trying to think like an adult. I'm trying to think like a teen. And in that case, it may be more like a destination, right? And I don't want people to get the impression that this is just a store for kids under the age of 20, right? 5 to 19 is what they say. I mean, they do have kids. They do have adults also who shop there for convenience, or they're shopping for their children, right? So,
sure.
But I do get the sense that there is some. There is, if there are switching costs, it's very, very, very small.
Yeah. Let's move on to, let's continue our discussion with this checklist. I think you brought up a few good points here about price, the demographic, kind of the brand around that. So let's just go down the list here. Low cost. Do they have low cost competitive advantage?
No, but I do think that there's a interesting component to that, which is they do buy some closeout merchandise, some sale merchandise that allows them to get a better discount. And they do cite buyers, their buying ability to being able to address some of that. And I that kind of reminds me of the TJ Maxx and Ross stores model where, excuse me, they're able to either get clothes that are specifically designed for that kind of store, so that they're all able to offer, a shirt or something like that. And Five Below does do some of that. One of the things that is interesting is, they claim as their store base expands, they will get better economies of scales with their vendors and their distributors, and then that they would be able to lower their price point. So I would say at this point, they don't have a low cost advantage. But they could have one in the future.
Okay. Good to know. Obviously, yeah, cost will go down with scale, and it sounds like from what you said, they don't quite have the scale of bigger retailers to provide that sort of competitive advantage at this point. So let's move on to the last, which is intangible assets. I think we touched on some of that in our previous discussion, talking about competitive advantage. Do you have anything here in terms of intangible assets as a competitive advantage?
So they cite their executive team and their buying merchandising officer, and in fact, they incentivize some of their executives based on inventory turnover. And I mean, their financials are very good in terms of growth and same store sales and things like that. I'm not thoroughly convinced, though, that's like a true intangible asset that somebody else couldn't replicate, right? If I were to hire that person away and just pay them a little more money, would I be able to replicate their buying, capability? That being said, I do think that, the retail environment that we operate in right now is super competitive. And if you look at a company, like you look at clothing companies right now, and if they have a bad season in terms of their merchandising and things like that, it is they hemorrhage cash, right? And so you have to be kind of careful with these businesses and monitor them closely, because like a company like Walmart, it doesn't matter as much, right? You're not a niche retailer. You're not targeting a specific demographic. Walmart is like stacking them cheap and selling them deep, right? Stacking them deep and selling them cheap. Thank you for butchering that. So Five Below has to be in touch with what is going on with their customer base, because if the teen market, which is very fickle, changes their tune, then they may miss out, right? And sometimes the customers don't come back, especially if there's a new place to go. So
yeah, I think as you were talking about that, there was a company that you and I both very well know, and I think you were thinking about that company.
I was, yes.
Yeah, Francesca.
Right.
So Francesca is a good example kind of that, where I'll let you guys kind of look into it, but it's a company that's based out of Houston, and they missed a season, and it really did a number on their finances and the future. So any sort of retail of this size, targeting specific demographic, that needs to be really followed closely in terms of inventory level and merchandising and things of that sort. I also was thinking about Steinmart.
Yep.
So Steinmart, Francesca, obviously there is a huge headwind in terms of retail, just any brick and mortar retail, generally speaking. That also plays a huge role into this. But having a close eye on actual merchandising and the turnover and the inventory management, I think those things are very important to look into if you want to play in the retail space as an investor.
Yeah, I think that is definitely the case. You have to be very careful about these kind of businesses, because they can turn on a dime, and and that makes me think that there's less of a moat here than a company like Walmart. They're going to have shoppers regardless. Dollar General is going to have shoppers because they're selling them at a low cost, right? And when you have a large store, and you're not selling things that people are constantly replenishing, right? I mean, imagine for Five Below right now, parents are going to be out of work. Their kids are going to have a lot less disposable income. What does that do to Five Below's customer base? Well, I think it's going to shred them, right? I mean, I don't see why kids are going to come back to the store if their parents are struggling, or if their people are out of work, or teens are going to be also out of work, and they'll have less spending money. So, this is the kind of thing that I'm not saying that it won't, that it'll go to zero, but I do think like right now things are going to be very tough for them.
Yeah, it's an interesting paradox here that you point out. which is that the demographic that they're targeting was very attractive for the very reason that it can be very detrimental.
Right.
In that the demographic that we're targeting here is attractive because they have disposable income, right? All their money is disposable income. Yet at the same time, the flip side of that is it is very detrimental to the business in downturn because all of their income, all of their spending is not essential, so they're going to cut back on that. So
yep,
it's a double-sided. What's the saying? I forgot.
Double-edged sword. Yeah.
There we go. Yeah. Okay. So let's move on from that and talk about the next question, which is how durable is the competitive advantage and what are the risks to the current competitive advantage? I think we touched on some of that, but if we could just summarize that here quickly, Hari.
I think it's pretty weak. I mean, I'm not discounting the loyalty and all of the things that the company has said exist. I think that you looked at their same store sales growth, and in 2019 it kind of shrunk. It was by 0.6%, I think. So, after being 3% and a little bit higher, same store sales is kind of the marker of a retail business's success. And you look at Dollar General, and I think in 25 years or something crazy, they've had like 1 quarter or 2 quarters of negative same store sales growth. So I do think that Five Below, despite their claim to having that store base, I mean, it's going to be negative 15 or 20%, if not more, for Q2 of 2020 versus 2019. And I mean, I expect pain in the Q3 as well. That being said, it all depends on how quickly the consumer rebounds. When the job market opens up back again, and most states go back to work. How quickly does that happen, and how much does this stimulus really get people going back? I think that's going to be a big part of it.
Yeah. And as we always talk about, risk is associated with how much price you pay for the business. And for a company like this, where there doesn't seem to be a strong competitive advantage, you can mitigate that by paying very little for this company. And we'll get to that in the second episode in terms of valuation. So let's move on to the next question, which is, what are the company's long-term prospects and run rate for growth?
So the company had... in February 2020 had 900 stores that were open. And they claim that they can have 2,500 stores across the United States. They're already in 33 states, so I imagine the expansion will include going to new states, but also expansion inside their existing places. So, when I started shopping there, I think the first time I went there, I wasn't even in in Houston where I live. I just found it in Austin when I was visiting, and I thought it was a neat place. And then since then, I think there are now 3 stores within 15 minutes, of me. So it is cropped up more frequently. I think they have to be careful, that you want to be close, but you don't want to be too close to each other to cannibalize your own store. So I think they have a fairly large runway for growth. And they've now, one of the initiatives that they did, obviously the name of the company is Five Below, which I thought that had something to do with them selling like frozen stuff or something like that when I initially, but it actually has to do with their price, obviously. But they now added a category in 2020 for $10 and below. So I'm interested to see how that impacts sales, if that brings in new items. The stores are relatively small. I think they're about 75 to 8,500 square feet, which is not huge, but it's like a mid-sized, kind of store. There isn't a whole lot of room to sell more items. So I wonder if the $10 price point higher margin or not, and that's going to be interesting to watch going forward. But yeah, I think the same store sales growth has not been great, and if it were like 3, 4, 5% consistently, I would be much more comfortable. But it's kind of slowed down a little bit, and so a lot of their growth is going to be growth through new store sales, right? So we'll talk a little bit about that when we talk about profitability. They are a pretty profitable business, but what I find interesting is in order for them to grow, their equity base has to grow accordingly too, right? And so they're just like any retail store, they're going to be tied very heavily to their equity base. And they've taken on debt recently to do that. So we can talk about that some more when we talk about profitability.
Okay, great. So it sounds like, just to summarize, sounds like there is quite decent runway for growth in terms of the profitability and capital efficiency. Some question marks there.
Yeah.
Okay, let's move on to the next question. Does the company require a lot of capital reinvestment to maintain its business? Can it grow without any further reinvestment?
So, we look at this in terms of, what does it take to maintain their business, right? And last week we talked about Carnival Cruise Lines, which, by the way, bumped a lot after we recorded the podcast. So if you're just listening to this, you're like, Becco, you just ruined it for me. Like, I was ready to buy, and then, all 8 million of our listeners just went in and bought it. So, no, but asset heavy businesses have to spend a lot of money to maintain their business, right? A company like this, the interesting part about retail is, you typically have 30 days to buy your goods, to pay your distributor. So if you sell your items in 30 days, you can actually, if you have a very high acceleration of your sell through, you basically have to pay nothing to sell an item, right? You essentially get cash from your customer, take that and pay back your supplier. And I think Five Below has some benefit there. There's some benefit to that because of their high sell-through rate. Costco is kind of the king of this. They get actually a longer term to pay them back, 90 days. Anyway, the idea here is, when you're trying to sell through, with a business like Five Below, you have some capital that you have to put in. But what I found interesting was it costs only $300,000 for them to start a new store, and that includes the inventory that they have. And if you think about it, bubble gum and candy and stuff like that, you can buy a lot of $5 goods for $300,000, right? So you can stock your inventory pretty quickly and you get your company up and running. So what does it take to actually maintain their stores? Well, not a whole lot if you really think about it, right? It's a, they have linoleum floors. They have they have to do some maintenance and upgrades, to clean and, do that kind of stuff. But it doesn't really take a whole lot to do that. So they do spend some on capital expenditure, but it's not a whole lot. So
is just curious, 300,000 for a single store to be up and running from scratch, and does that include both the variable and fixed cost here, or is it are you just talking about inventory?
So it's inventory plus build out. So you have to do the build out, which is a one-time cost, and then it includes other items there. Most leaseholders will give you some allotment of cash when you do a 5-year rental to do some of this. So they said all of this is net that. So I have a feeling they have like a pretty strict requirement when they approach a landlord and say, I need these things and I need this much to pay it off, so that they can keep their $300,000 So it includes net tenant allowances, inventory, and cash for the cash used for pre-opening expenses, which I imagine is we have to hire people, we have to get a manager, so but the manager probably has to be hired a month or two before the store even opens, so that so there's some expenses with that. And then obviously they have to go and find somebody, so they may have a commercial real estate person, that kind of stuff.
Yeah.
So yeah, this is $300,000 is not a whole lot of money when you consider that in the first year they have sales of 1.8 million. So
wow. Yeah, that's pretty good, huh?
Yeah.
Okay, so love to dig into more of that when we get to the financials part. But let's move on to the next question. Does the business have favorable relationships with the following? Customers? How does it look in terms of customer relationship here?
Yeah, I don't see any red flags in any of these categories. Customers definitely, nothing there. So
okay. So customers, suppliers, employees, regulators, and communities. This really question is really about raising any red flags, like you mentioned, and it sounds like everything's green light here.
Yeah. So the only, none of their vendors account for more than 7% of revenue. So, and I don't think any of their vendors would ever pull out. I'm not seeing anything here that really strikes me as concerning. Their employees are not unionized. They don't have any regulatory things that they, other than the normal labor kind of regulatory stuff. So not really anything to be worried about.
Okay. Great. Awesome. Thank you for that, Hari. We'll stop there for this episode, and we'll get to the financials, management, and valuation in the next episode. So please stay tuned. And as I mentioned earlier in the episode, if you guys have questions about specific companies, you guys want us to review specific companies, please email us with that information at info@valueinvestor.org. And if you'd like a copy of this checklist, also email us to that same email address, info@valueinvestor.org. All right. Thank you guys so much. We'll see you guys in the next episode.
Thanks.